Hi, Chris Cortland here, and Catrina South asked me to share a loan program with you that is actually going to dramatically improve your financial future. Now, the program is called the All-in-One Loan. What I like to do is refer it to the Principal First Loan. So, the short video here is why Catrina is actually suggesting using the All-in-One to help fund your financial future. Now, we first have to understand the mortgage math. Right? How does that work? Well, here's what happens, and here's why it goes against or works against you. Compound interest. So this is the lender's dream. Remember, Einstein said one time that compound interest is actually the eighth wonder of the world. Well, he who understands it earns it, the banks, and he who doesn't understand it pays it, us as the borrowers. Now, the thing to understand about compound interest is just look at your mortgage statement each month. You can see that you've got this amount of interest going out and this amount of principal being paid. Well, here's a quick synopsis of, or really a loan calendar, amortization schedule, whatever you like to call it. I'm going to run a $500,000 loan at 6.5 or 6.25%. Now, the note rate is 6.25. Understand the difference between note rate and effective interest rate. The note rate gives you the principal and interest payment. Now, the effective interest rate is the rate in which you're paying for the term of the loan, right? So that's the real percentage that the bank is making. In this case, it's 121%. Look at how much interest that you're paying, $608,000 plus in interest paying back to the lender if you never pay ahead on your mortgage. Now, it's important to understand also some of the other numbers. Like, how about the first month's number? 449% more interest that you're paying than principal. Well, let's fire down to year 15. It does get better. Well, it's down to 56% more interest than principal. You get the feeling? You just start to understand what I'm talking about. Here's the other important part of effective interest rate mortgage math. So what happens is that it takes 228 payments, and again, if you never pay ahead, 19 years for the principal amount to catch up to the interest amount within your P&I payment. Now, let's look at $1 million loan. 7.5%, that's where the rates were when I did this video. Now, 7.5% is the note rate, gives you the principal and interest payment, but let's look at how much interest that you're paying back. $1.5 million in interest alone. That's 151% effective interest rate if you never pay ahead on your mortgage. Now, again, quick payments. Payment one, you pay 742% more in interest than you did in principal. But it gets better. Again, let's roll on down to year 15. 108% more in interest than you pay in principal. Now you can understand why Catrina really wants you to understand finances, right? This is not just throw something together and see what happens. It takes 250 months for the principal to catch up with the interest amount, how much principal that you're paying versus how much interest you're paying. Now, what I want to do is cover time value of money. It's important to understand how time works within, and as far as rates go, I'm going to show you where interest rates are not that important. Now, yes, having a lower interest rate is better than a higher interest rate, but don't let that blow your mind because this is what's going to happen. Time value of money. We're going to use an example, 30-year rate, right? 30-year term. So in a 30-year term, $500,000 at 6.25%, you're going to pay back a total of $1.108 million in 30 years. Let's do the 15-year time value of money. 15 years, same $500,000. Now what I'm going to do is raise it 3% to 9.25%. I know, 15 years normally lower than the 30-year, but in this situation, this example, time value of money, 9.25%, 15 years, you're going to save over $182,000 in interest because of the time. Let's move one more over to the all-in-one loan. Now, 8.5% interest plus, right? you're going to save over $419,000 in interest. I'm going to show you how this works. Now, the question is this: are you ready to save a lot of money without changing your monthly budget? What you have to do is understand that you got to start paying principal first. This is how this program works. Remember, conventional, interest, principal. We flip that around and say principal, interest. Just something that happens with this program. Now, what is the all-in-one loan? Real simple. It's a line of credit combined with your checking account. Now, what's important about this line of credit is this is a 30-year term. Okay? If you go to your bank and say, hey, I want to get a line of credit on my house. Here's what happens is the typical is 10-year draw, right? So you can use it, repay it, use it, repay it over 10 years. Now, the interest rate can change as well if it's an adjustable, same thing, and it's affected by the Fed rate. Okay? So here's the other thing, is that at the end of 10 years, if you have a balance, the bank's going to send you a notice a couple of months earlier and say, here's what you need to do. Over the next 15, 20 years, depending on the term, you just have to pay it back. You can't use it anymore. Okay? You can only pay it back. Now, with the all-in-one loan, it's a 30-year term. Here's what's great. If you remember back in the day, 12 years ago, when the mortgage meltdown happened, credit lines were being shut down. Okay? They were being reduced. The bank said, nope, can't use it, sorry. The values have dropped. Good news with the all-in-one. If today's value is here and tomorrow's value is here, with a conventional line of credit, this is a problem. With the all-in-one, there is no problem because the value stays at the original amount. Okay? Awesome. Now, with the checking account, you get the same things. With a new checking account, you get the online bill pay, online statements, all the things that you're used to. Now, let's go over real quickly how this works so you can see how it pays down much faster. So the top of the green line is the credit line, okay? So we're just going to use a simple number of $10,000 net income coming in each month. So if you deposit $10,000, let's go $500,000 loan amount, $10,000 net income coming in, you now are at $490. Oh, wait, you say, Chris, I need to still pay my bills. You're right. So what you do is the equity, because it's tied to the checking account, you use the money, and in this case, just say it's $5,000, right? Just because of the way the chart is. So $10,000 come in, you use $5,000 to pay your expenses. So it goes from $300 or $500 to $490, $490, $495, $495 down to $485 the following month, and so on and so forth. So you can see the step down is much faster. Now, how do we figure out the numbers? Well, we have what's called a comparison simulator. Now, in this scenario, the borrower, in this case, has $10,000 net income, okay, not gross, net income going into deposits, and they have leftover $2,500 a month, which means that they expend $7,500 in their expenses every month, right? Now, again, everything fluctuates, but we're just going to use fixed numbers. Now, over the period of the next 10.4 years, this loan is going to be paid off without changing the budget. Okay? This is why Catrina is so excited about this, because she has had this program. She knows how it works. This is why she's fired up about it. She knows it. Okay? Now, let's look at the total amount of savings, $419,000 in interest saved. Okay? Let's look at a big number. Oh, actually, wait. Let's talk about effective interest rate first. Okay, so the effective interest rate, remember, 121% if you didn't pay ahead, 2.25% effective interest rate. Why? Because you're paying down the principal so fast. That's what happens with effective interest rate. It lowers the effective interest rate over time. Now, this chart, what it does is the black line is the all-in-one line, okay, the payoff time frame. The blue line is actually the credit line. So what happens here is that the white space in between the blue line and the black line is the equity available to you to use for whichever investment that you want to use it for. Smart money, okay? This is where Catrina comes in to help you understand where that money goes. Now, $1 million, again, 12.8 years. Now, a little difference here is that on a $1 million loan, what I did was I used $15,000 as net income, 25% left over at the end of the month, which is about $3,200. And in this case, they're saving $875,000 in interest payments. Huge, huge. And again, effective interest rate, 3.6% and change, not 151%. Need to understand that. Now again, same graph, but let me show you this. So what happens here as we finish up is that you use it, reuse it, use it, reuse it, and you can see how, again, people have used it different ways, use the cash available to put into an investment, whatever that investment might be. Now, to finish up here is let's find out how the all-in-one loan can help fund your safe investments, okay? That's what Catrina's going to help you with. Now, give me a call, give Catrina a call. We'll work your numbers and see how this program can serve you. Thank you so much, and have a great day.